Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus, and I'm Hiral Dadia. One stock that we're looking at pretty closely overall is ideaForge. If you see from a Q2 perspective, your profits have slumped almost a little over 75%. Revenues have seen a dip as well, and overall, clearly your other income though has been up by 5.3 times. Now, clearly, let's understand from the management as to what's not worked in the quarter and what's the trajectory looking like going ahead. Ankit Mehta, CEO at ideaForge Technology, joins in. Ankit, good morning and welcome to the show.
Good morning. How are you doing?
I'm good, thank you. Hope you're doing well as well too.
Yes, absolutely.
Ankit, overall, clearly the quarter we are seeing a downtick that's come in. At operational level, also we've seen a loss here. What's not worked?
So actually, what happens is that our customers have specific delivery schedules on our contracts.
Hmm.
So we are typically tracking ourselves based on those delivery schedules, and from that point of view, whatever was expected to be delivered in the last quarter, we've delivered. So that way is this is what we have been able to achieve based on the customers' requirements and deliverable timelines. Then whatever contracts we have right now, we are in the build-up phase for the inventory to deliver those contracts based on their timelines. So we have to time it based on when the customer expects the delivery, and then accordingly build our inventory and go ahead and bill it.
So basically, are you trying to say that the new orders versus the book to bill that has a mismatch right now?
So the new orders have just come in. Typically, we tend to create inventory and order material once the order comes into place, given the nature of our business. So from that point of view, for the new orders, we have to get into the entire build phase from beginning. From the perspective of the previous orders that we had received in the prior period, prior to last quarter, in those orders, we would have already sort of built in the inventory, we would have brought in the inventory, we would have converted into finished goods. And based on the customer timelines, we would have dispatched those. And whatever is due in this quarter and the next quarter, we will be doing the same thing. We would have started preparation for some of the opportunities already, and we would be very close to delivery there. And then in others, we will plan it based on the delivery timelines on those contracts. So we have to basically time it based on the contractual obligations that we have with the end customer.
Okay. So, Ankit, overall, currently, what's the order book that you're sitting on? And two,
So,
what's the delivery timeline on the same?
right. So the order book that we are sitting on is about 253 crores. And the delivery timeline of when the orders come in typically is about a year. In one of the contracts, which we had won actually slightly earlier, the delivery timeline was 2 years in two fairly large chunks. One of those chunks was delivered in the first quarter of the year, which we had already mentioned. And the second preparation for the second one is currently underway for various processes around it. So we have one opportunity that was a larger, longer time frame opportunity, which is in its second delivery period in terms of contractual obligations. And then the new orders that have come in, those are under execution at this point in time based on their delivery timelines. Typically, there is a lead to first delivery in batches, and then other batches happen subsequently back to back.
Okay. So, Ankit, overall, if you have to look at the breakup between defense and civil, the first half of FY24 is still focusing on defense, though in this quarter itself, civil has increased substantially to 31% versus the defense at 69. Uh, are you looking to move towards a 50-50 revenue contribution from both these segments? And if so, how does this impact margins and profitability?
So what happens is that in our business, in the short term, because defense contracts are fairly sizable and chunky, it is unlikely that the balance will tip towards 50-50 in the short term. We do expect that in the horizon of 3 to 5 year time frame, we will see that there will be a increased contribution close to 40% from civil and 60% from defense. But in the near term, it is going to remain skewed towards defense, given the chunkiness of the opportunities that we close in that particular business segment. However, from a profitability point of view, it is not necessary that either of the segments have a specific inclinations towards higher or lower profitability. It is based on the competitiveness of the opportunity we are bidding in. And we take decisions based on that rather than particularly the nature of the business or the type of customer. So it's entirely dependent on the competitiveness in the opportunity.
Okay. So currently, if you could help me understand the margin profile of on an average on a blended basis for defense contracts versus how they pan out for civil contracts.
It is very similar. Like if you look at the Q1 margin profile, then I would say that that is the that's the kind of margin profile that and better than that is typically what averages for our overall blended basis margins. So that's broadly where the numbers typically sit. But from a sector perspective, it is genuinely opportunity dependent, and you will find that on a blended basis, both are very similar in that broad sense.
And where does the utilization stand, Ankit, right now?
Utilization in terms of the proceeds.
Capacity.
Capacity in terms of utilization, we are fairly high because, like I said, we are in the build phase for the next delivery lots for some of our contracts. So capacity utilization is at a good level at this point in time, and this capacity utilization is actually a single shift capacity utilization that I'm talking about. The facility itself that we are in today has the ability to do multiple shifts, and therefore we have the headroom to increase our capacity, when required.
Okay. Currently, from a manufacturing perspective, what percentage of the raw materials is, domestically sourced, and what percentage is coming in via imports?
So if I were to just talk about the imports we would have done in H1, as a fraction of revenue, it would be about 30%.
And is that on a declining trend or is that on an increasing trend?
I would say that it's slightly dependent on how much inventory we are building. So I would not necessarily put it on a declining or an increasing trend, because if we are building a slightly more advanced inventory block, then that number will vary based on that rather than on the trend, because our indigenization is increasing for sure. And we are increasingly creating more and more subsystems in our country, and that is something that we have aggressively taken a target towards in ideaForge, and we are progressing in that direction quite rapidly. So the indigenization is happening, but at the same time, if we are stocking for certain long lead items, you will see that there is an increase in import temporarily on that basis, while
Okay.
overall indigenization would keep going up.
Right. And Ankit, very lastly, so if you have to look at FY24 uh, at operational level, do you think you will be able to be back in the black?
Back in the
Black.
So, from the achievement of our goals is concerned, we are very confident that we'll be able to get to what our goals are for the annual targets. And therefore, the progress in terms of what our plans are has been relatively on track at this point in time. And therefore, we should get to the right, levels that are required.
Right. All right, Ankit. Thank you so much for joining us on the show and sharing the views. So that's ideaForge, clearly looking at what could be going ahead. But 38% is the kind of cuts that we've seen since listing with regards to where ideaForge is concerned. But let's quickly move on to other stocks that are in focus as well. An interesting one is HPCL. Clearly, no major moves coming in terms of today's session, but the kind of moves that we've seen in the last 4 to 5 trading sessions has been pretty strong, almost a 16 to 17% up move in the last 5 days. A lot of factors that are accompanying this. Mika standing by to get us more. Mika, overall, if you see HPCL, uh, earnings, brokerage upgrades, plus you have crude as a benefit. What does this actually look like if you have to look at a summation?
So in terms of stock performance first, it's been gaining for the past 9 consecutive sessions. And in the past 5 sessions, it's up 19%. And it's also in the green today. Now, what's working for the company, there are a few factors. First, with the quarter 2 earnings, although the metrics in terms of profit were down, the numbers did beat estimates, and they were well up on a yearly basis. And in terms of the lower crude prices, crude is down 9% this month itself. So what basically this does for an oil marketing company, it reduces the cost of goods sold. It improves the gross refining margins. The gross refining margins are higher when crude prices are lower, and this in total impacts the profitability of the company and the margins in a good way. Additionally, the latest directory comment has been very positive. The director stated that the company plans a 75,000 crore capex in the next 5 years. It also plans to run its Vizag refinery at a 13.5 million ton capacity in quarter 3. And furthermore, there have also been talks about the company possibly selling their lubricant unit to its separate entity. Additionally, the street and the brokerage view have also been positive. The stock has 20 buy calls, 8 hold calls, and 4 sell calls with a 5.6% 12-month return potential. Morgan Stanley has double upgraded its rating on HPCL to an overweight and increased its target price to 364, which is a 22% upset according to yesterday's close. Then we also have Prabhudas Leeladhar, which have maintained a hold rating at a 272 target price and have raised the FY 24-25 estimates by 8.5 and 17.6%. And then we also have Nirmal Bank that upgraded its rating from a hold to a buy and raised the target price for HPCL to 350, which is a 19% increase. So there's a lot of things that have been lining up for the stock.
It's an interesting one to watch out for as well. In fact, stocks of oil marketing companies have been surging as well on the back of lower crude prices, right? So that could be a space we should be watching out for. Thank you, Mika, for getting us the details with regards to where OMCs are concerned. But moving on from the OMC pack, another stock that has been in focus in terms of today's session is a Gujarat Narmada Valley. If you see the counter as well, clearly in terms of the stock price, the stock has been trading under pressure. It was down around 4 to 5% as the trade opened up, recovered slightly, and now seeing cuts of almost 2.5%. Two things coming in there. One is in terms of where earnings are concerned, and secondly, if you talk about the buyback that has been announced. Now let's head across to Himansh to understand more. Himansh, two things that we are looking at, right, in terms of Gujarat Narmada Valley. What is the buyback telling you? Because usually when you see buybacks happening, it usually is done to support the stock price overall.
Absolutely.
Here it seems that the stock is trading under pressure. Is it the earnings that is impacting it or the buyback news?
So in terms of the buyback, I think it quite contrary to what the Gujarat government planned for the stock. So Gujarat government recently mandated that companies, Gujarat PSUs, are supposed to pay off about 30% of their net profits for the year or 5% of their net worth and distribute them as dividends or returns to shareholders in the forms of buyback and stock split. But with Gujarat Fertilizers, we are seeing the stock under pressure. And here's why, where the company has announced a buyback of 84 lakh equity shares or 5.46% stake. And the record date for the same is set for November 24th. Now, the buyback price is set at 770, which represents a premium of about 11% to the previous close, and is now that it's trading lower, it represents a significantly greater premium. And the buyback price indicates that the aggregate total offer size is over 652 crores. Now, this is almost 44% of their FY23's net profit as well. Now, the retail quota is reserved for at least 15% of the total offer size, which is about 12.7 lakhs. And now coming on to what's this entire thing about? Well, GNFC has been paying dividends for the past 8 consecutive years. And despite the same, the buyback now is expected to provide some support. And we also saw GMDC, which revised its dividend upwards earlier this year, which also offered a lot of support to the stock price. And it has been trending upwards since. So let's see how the stock performs today and how the buyback receives in terms of its response.
Right. So that's with regards to where Gujarat Narmada is concerned. In fact, Gujarat State Fertilizer and Chemicals is also another one that is related to this company. That stock is also trading under pressure with cuts of around 1.2% coming in there. Thanks so much for getting us the details as well with regards to an update on this one. So that's with regards to where Gujarat State Fertilizer and Gujarat Narmada Valley are concerned. But moving on, as we had mentioned, the pharma pack continues to remain in focus in today's session. Yesterday also, it was one of the top gaining sectors. A lot of news coming in across Lupin. You have JB Chemicals, as well as you have the other one, which is Biocon and Eris Life Science. But let's head across to Varsha with an update on two of the stocks that she has been tracking pretty closely. Let's start with the Lupin. Varsha, good morning. How have the numbers been, and what is the quarter looking like?
Yeah, so as we all know that Lupin came out with its results yesterday and stock has reacted to it. So shares of Lupin rose around 2% and hit a 52-week high of 1,232 in the opening trade. Let's see how the numbers were. So the company numbers beat estimates on all parameters. If you see, revenues up 21% and EBITDA was up over 2x at 917 crore. Now margins were 18% versus 10% last year. Now this is because of the cost of raw material, which was 24% last year, was 20% this year. So huge uptick in margin due to decreasing cost of raw material. Also, if you see, the net profit was up over 3x at 489 crore. Now, other income also helped in uptick of this net profit. The US launch of a tiotropium DPI, which is used to treat lung diseases like asthma, was the highlight of the quarter. And also, if you see, the North America sales was up 17% and India sales was up 3%. Europe and Middle East was up almost 19%. And global API sales was around 20%. But if you see, the overall cost management and operating leverage helped company to drive strong top line and bottom line growth. So let's see how Lupin goes all the day. But yeah, shares were up almost 2%. Then we have, as I said, JB Chemicals. Now, the interesting thing is, if you see, the revenue were up to 9%. Now, the revenue growth was led by chronic segment and acquired portfolio and good product mix. Also, the domestic formulation sales continue to show double-digit growth led by scale up in acquired portfolio and chronic brands. Now, if you see, the EBITDA was up to 32%, but margins, the interesting thing is margins were at 27% versus 22%. Now, this is on the back of improved cost initiatives by the company, CDMO contribution, and rationalization of the tender business in South Africa, which was a low margin business. Also, if you see, net profit was up 35%. Now, if you there was con call yesterday, so let's look at the con call highlights. The company said the Q3 will be better growth for domestic formulation given the low base. Also, company has done restructuring in South Africa market related to the tender business, which will result in 120 crore of revenue loss in FY24. But mind you, this business was low margin business. Now company will be concentrating on the private business, which is a high margin business. So huge uptick in margin. Then the CDMO segment is likely to remain soft in H2. And lastly, company had guided margins of 25 to 27% and should achieve at higher end of demand.
Right. So that's both the counters. In fact, JB as well, if you see, is up almost around 4.5% in traders today. So interesting moves coming in there. Thanks, Varsha, for getting us the details. A whole host of companies that are in focus in today's session. A lot of stock-specific action is what we are witnessing. But overall, if you see from a market's perspective, you have Nifty 50, which is hovering around those 19,450 levels. So interesting moves there, 130 points up move coming in terms of Bank Nifty as well. And if you see in terms of the advanced decline ratio, absolutely in favor of the bulls with the M&M, which is seeing gains of 3%, which will be reporting numbers tomorrow. Apollo Hospitals as well ahead of numbers is seeing gains of little over 2% come in there. That's all that we have on this session. Thanks for watching. And lots more lined up on the other side. Please stay tuned to BQ Prime.
I wanted to wish all the viewers of BQ Prime and the channel a very happy festivities and a very happy Diwali. Happy investing.